National University of Singapore Business School, and also from Center of Asset Management, Research and Investments, also at NUS Business School. We have already have introduction to our esteemed panel here, and since we are running a little bit out of time, I guess what we're gonna do, we're gonna quickly jump to business here and start talking, which means that each panel will give, each panel member will have around 3 to 5 minutes to give us their own views about the topic today. So I guess we're gonna start from next to me is Mr. Monem Salam.
Thank you very much. Bismillahir Rahmanir Rahim. Alhamdulillah Rabbil Alameen. As-salatu was-salam ala ashraf al-anbiya wal-mursaleen Muhammad sallallahu alaihi wasallam. I wanted to, so we're talking about the global markets, and so I just wanted to maybe throw out some thoughts about what will happen next year, those type of things. But before I do that, I wanted to just give you an idea that, you know, that the funds market that we have, the Islamic funds market, is actually directly correlated with the global markets, whether it be regionally. So for example, if you have Malaysian funds dealing with Malaysia, or the GCC funds dealing with GCC, or Islamic funds that are global, that deal with the global markets, what you find obviously is as the markets go up, these funds, assets under management go up. When the markets go down, the opposite is true as well. And so, but here's the other interesting fact that I actually was doing some research and I found out, was that in the last 3 years, on a cumulative basis, the Islamic funds, on average, were up about 39.7%, roughly 40% on a cumulative basis. But if you look at the average AUM in these funds, it was actually only up 22%. Right? So think about that. So you're up, your returns are 40%, and your AUM is only up 22%. So I'll leave it up to you to figure out where the difference in that is actually coming in. But going into next year, I mean, there's a lot of things that are happening. You know, the Fed funds rate most people think is going to increase, and what that implicates to the Islamic funds market. The one thing that I will tell you is that although some people will argue that, sorry, I thought you said, and some people will argue that you know, if you look at the long run, then Islamic funds or Islamic indexes actually outperform conventional ones. What I would like to posit or argue is the fact that over the long run, it doesn't matter because they equal each other out and there's statistically no difference. But however, you can actually make money when in certain environments when Islamic funds actually do better. And in those environments, if you look at it for the past, let's say, 6 years or so after the GFC, the financial crisis of 2008, that has not been the case, meaning that most Islamic funds have actually underperformed. And the reason is because typically when banks do well and where highly leveraged companies do well, Islamic funds will not do well just based on the criteria that we have. So that's in a rising market initially coming out of a recession. But in a recession time or going into a recession, you will find that, that Islamic funds actually do perform really well. So going into that environment, what does that mean for next year? As the interest rates go up, right, you're probably going to find initially that the banks will do well. They're going to actually have a profit margin that'll be better, and thus Islamic funds will underperform. But in the long run, as the interest rate go up, that does slow down the economy, and as the economy slows down, highly indebted companies end up doing more poorly, and that's where Islamic funds can actually come in and do a little bit better. And so I want to leave that thought and say that if next year we do find that there is a slowdown in the global economy, then I think you'll find that then that's where the Islamic funds will be able to do a lot better.
Good day, ladies and gentlemen. Once again, for a lot of what Monem said, I can wholly endorse between conventional and Sharia compliant funds, as my very short legs straddle both sides of that particular equation. But I'd like to deviate a bit from what my learned colleague has said and talk a little bit more on the topic of whether, in fact, interest rates will tighten next year and what it's going to mean to liquidity on the global markets. I look at the globe as, yes, every country is enmeshed together. A butterfly can flutter its wings in Brazil and cause a tsunami in Japan. But nevertheless, we have to look at different regions, and things are happening differently in the different regions. I think we can say with a fair degree of certainty, 2015, we will see the Fed funds rate go up, primarily because it can't go down. But it will certainly go up. Precisely which month, I think we're not so sure, but at some time it will. I'm not so certain that this will happen with the European Central Bank and sovereign central banks in the Eurozone. Since about April of this year, the different central banks seem to have diverged. We are seeing a trend towards lowering of interest rates in the Eurozone and in a number of the peripheral regions in Europe. And I do not think that next year we're going to be looking at tightening at all. I think, if anything, there's going to be more stimulation in a region which is the world's second largest economy. Certainly, with regard to China, I do not believe that we are going to be looking at tightening as a general policy across all sectors. In China, they might well start restricting a booming housing market. They might well start restricting certain practices in coastal regions. But I do not think we are going to see a general tightening in China. There is probably a greater case for some stimulus in the Chinese economy as well. I won't go into great detail in Japan, but Abenomics seems to be looking to increase inflation and not tend towards deflation, and the latest news on their sales tax certainly confirms this. So the point that I'm trying to make here is that when we're talking global, we're talking different things are happening in different places. They are happening in different speeds as well. And certainly with regard to tightening or the opposite, more stimulation, we cannot use a one-size-fits-all argument in the globe today.
I just wanted to add to what Monem has said, but probably from a different take. Sharia funds essentially are a subset of the global equity investment universe. So as Monem has said, yes, there is perfect correlation between global equities and Sharia equities. If you look at the two periods of when the market was down in 2002 and 2009, March 2009, and if you overlay the graph of say Dow Jones Islamic Index or even the Russell Ideal Ratings Islamic Index over the proxy for global equities, which you can take the S&P, there is perfect correlation. In fact, during the global financial crisis, there was perfect correlation across all asset classes. Having said that, as Monem has pointed out, why do some funds perform better than others? End of the day, I think it's up to manager selection. So does equities fund manager in a Sharia environment, is he handicapped, or is he, does he have an advantage compared to his non-Sharia counterparts? I think the question is still open. As you know, a lot of the hedge funds that were able to go short during global financial crisis made a lot of money, right? Whether Islamic fund managers can go short or not, that is, I think, another question. But I think the other consideration is, what is the investment mandate of the individual fund manager? As I mentioned, the Sharia equities investment universe for equities is a smaller subset of the global investment equities. Within the manager's mandate, what is the allocation, maximum allocation per stock that they are permitted to take? Why this is important? A lot of the fund managers that were not allowed to exceed certain exposure actually went into cash during the global financial crisis. And they were able to participate in the uptake of the equities. So again, this is a factor in determining the performance of certain fund managers vis-a-vis the correlation of the equities. So I just wanted to point out that at the end of the day, it's manager selection. And as with the non-Sharia equity funds, end of the day, I think that is the paramount selection criteria.
From my side, I think more or less the panelists are all in agreement that we may or we will be looking at a tighter monetary policy going forward. If you look at it from the two asset classes, the fixed income and equity asset class, on the fixed income side, I think most fund managers are pretty defensive today because of the tightening. But we must remember that the bond asset class isn't homogeneous. It's really a staggered so-called a ladder of bonds, meaning to say at the very bottom you have your sovereigns, followed by your corporates, followed by your emerging markets, and then maybe by your high yields. Within that space itself, of course, everybody's now trying to avoid the low developed country sovereigns. On the other spectrum, the high yield is really a very crowded place to be at this particular point. So from that perspective, what we're seeing now is the emerging market bonds are beginning to come back into favor. And within the emerging market space, of course, then you find the sukuks because it's the GCCs, it's Malaysia. So going forward into next year, potentially, from my point of view, the sukuks could ride on this flow back into emerging markets from the perspective that it sits right in the middle, and the top and bottom of that spectrum, bond spectrum, is probably places that you don't want to be at this point. From the equity side, I think it's more homogeneous from the perspective that we believe equities will do better, despite the fact that it's going to be a rising interest rate environment. We have to remember that currently we are in a very, very low interest rate environment. It is basically, give you an example, in Singapore, if corporates used to borrow at 5-6%, today they're borrowing at 2-3%. So basically that 2-3% buffer that they have, is as rates rise, they are still going to be saying, I've borrowed much higher because my long-term borrowing rates were much higher previously. So rising rates will not hit equity markets as hard as they will hit bond markets, at least for the first part of that rise in interest rates, because rates are just normalizing back to where they were supposed to be over the long run. It's that second segment whereby it goes beyond that 5-6% to 7, 8, 9%. That's where it hurts. So I think the equity markets will do well, and it will drag along. And I think, as my panelists all alluded to, on the equity side, the correlation is much tighter. I think so. Basically, I think the equities will, the Sharia compliant equities will just move along with all the other equities. It's the sukuk side which I think next year may outperform from the perspective that it's in a segment which probably will do well.
I have got some slides to share. I think I have gathered some information which actually corroborates with what most of the panel members are saying here. Okay, all right, sorry. Thank you. Do you have a clicker?
Oh, yes, slides. No, I need to
all right. Okay, all right. Sorry. I think what I've done is I've taken this information. I thought it would be better if I can show some charts in terms of returns of Islamic indices versus their counterparts, non-Islamic indices, different regions, risk-return profiles. And I think what Monem said is, in the grand scheme of things, they're probably very similar. But I would also share our challenges. Okay, I want to focus on growth, right? Obviously, there's a tremendous opportunity there. But I think it was mentioned yesterday as well. Funds, especially Sharia compliant funds, doesn't necessarily mean that only Muslim investors are allowed, or at least that notion, if there is any, should be squashed. And then our approach from a firm's perspective has been to attract non-Muslim investors as well. And the challenge is, when you look at recent performance over the last 8 years or so, in different regions, there is not a compelling evidence to say, especially for non-Muslim investors, they're agnostic. Okay, you come with a proposition. what we are trying to say is it's on an ethical front, right? You have all these, you're removing exposures to alcohol or tobacco, all these, this more social responsible investing. Obviously, we would have to showcase whether the returns are attractive enough for us to attract their investments, their assets. The take is we are not, obviously, yes, there are a lot of institutions, assets sitting idle. I think it was mentioned yesterday as well. Idle assets that are not being invested. And of course, there is that one avenue. But how about carving out of existing conventional assets and attract into the Islamic space? I think our approach has been, how do we approach to these non-Muslim investors So it's been, well, we can definitely promote Sharia investments under the ethical principle guidelines. The other thing is, can we also build strategies that would offer better returns and without assuming any additional risk? Still Sharia compliant, no difference there. So, and then obviously there's a lot of discussion on transparency and everything, so we were focusing on those strategies as well. Just to highlight a bit on, of course, this is where in the grand scheme of things, right, the volatilities of, I mean, if you see the red dots there, we have considered since 2009, the FTSE, Dow Jones, and MSCI, public information from Bloomberg, Islamic and as well as the non-Islamic indices, market cap. On the x-axis, your volatility, which is the risk, standard deviation, straightforward. And it's not really that different from 18% to 18.5 is just a needle in a haystack. I mean, it's pretty much clustered. But if you look at the returns, right, MSCI, this is the MSCI Islamic at about 5.25 per annum with annualized returns. This is the x-axis. So you could see versus a conventional index giving you about definitely close to 200 basis points per annum extra. So how do I convince a non-Muslim investor that they should gravitate towards or they should entertain our pitch to go, let's go towards the Islamic funds, right? Obviously, this is better if I were to look at Dow Jones versus a Dow Jones conventional here. But there is no compelling story here to say that, yes, Islamic automatically means that you get a better return. And we did this since 2007 because FTSE, we couldn't get the data from 2007 onwards. The same story here, basically same thing here as well. I mean, you don't get the returns. You're assuming the same risk, but you don't get the returns. And these returns are about 150 to 200 basis points per annum. And they compound. Global markets, slightly better story, I guess. So our pitch has been that how do we construct additional, other strategies that would offer better return proposition, possibly lower risk. And then the other thing that we were focusing on was we were in discussions with some of the asset owners, and they have indicated interest in terms of segregating some of their conventional assets into Islamic or Sharia compliant assets. So that's where I think my question from yesterday was on the asset allocation. So this was the discussion that we went on. How do they come about the asset allocation? Obviously, their liability profile is, asset liability profile is still the same, their commitments, but now they're shifting their asset allocation. And apparently they were telling us that they would probably follow the same current model of whatever the allocation. So we thought, okay, how about let's look at some research. And this is something from Towers Watson. This is since 1995. These are the allocations across different asset owners, pension funds. And you would see that the equities portion used to be 1995 from 49%, has climbed to 61 and is now at about 47 or so as of 2012. And I think this is also similar to what we are seeing in the news now. Japan is trying to increase their equity exposure. They are coming back up as well. And I think even Malaysia had a press release a couple of months ago that they are increasing their equity exposure. So we were taking this asset allocation, and if we were to apply to Islamic asset space, right? So we took this, because we couldn't find a lot of alternative assets where they have a small exposure here in the other assets. So we just took this slice of equities and fixed income. And if you go there, so that comes about at 60-40 allocation. This is the risk return that they would have realized over the last 3 years. About 10% return with about 10% risk, or slightly under 10%. But if you were to follow the same, right, same scheme and apply to a Islamic, you look at the Sukuk and Sharia equity indices and you apply the same, you are actually about the same risk level, but you're off by more than 100 basis points there on an annual basis. That's quite large. I don't know how they are going to overcome that, because they do have the same liability profile. And if you look at on a 5-year basis, yeah, it's about the same. Either they would have to increase their exposures to equities further to boost their returns, but they're assuming additional risk. And that's pretty much what I wanted to say.
Wow, this was just an excellent discussion from this esteemed panel. So many questions popping up in my head, but we only have 10 minutes left. So let's just go one by one, I guess. One thing that I was thinking when I came here, today's topic is performance outlook amidst liquidity tightening. That one kind of assumes that Sharia funds are not exposed to federal interest rates, to reserve interest rates, right? However, I want to pose this question: aren't Sukuk rates very highly correlated with the interest rates in conventional markets? Anyone would like to take this topic?
Well, so yes, they are, and the way you know that is because most of the Sukuk that come out have LIBOR plus or Euro money plus. I mean, whatever the rate would be, it's the plus something else. So that's one part of the correlation. The second part of it is if you look at the largest Sukuk holders of most of the Sukuk that are out there, you're going to find it's Western conventional institutions. And so it's a risk-reward ratio for them. I mean, if you look at it from a conventional perspective, a Sukuk is no more than an emerging market debt. And so you get a higher return for a little bit more risk that you actually take. And so if you have credit tightening in the developed world, what happens is there's usually a margin call from the emerging markets back into the developed world. And so that's when you see the sell-off. And so 2007, 2008, that's exactly what happened, is that it wasn't that the emerging markets were doing poorly. It was the fact that the asset managers in the West were having margin calls that they needed to sell their assets and bring them back to the U.S. to be able to keep up their requirements. And so that is that correlation is there. And so we do have to be careful whenever we're managing and know what's happening around the globe rather than just within your jurisdiction.
Thank you so much. Another question that I was thinking about is historical evidence. And we had the beautiful slides here. We've seen some historical evidence. And we were talking about global financial crisis. In global financial crisis, there was a dip. There was a huge losses in a lot of funds. However, as it was pointed out earlier, the hedge funds who were able to short, they've been able to do phenomenal. Now, how does this affect Sharia funds in times of crisis? Being able to short may actually help the returns, and does that help? Anybody wants to think about that? All right, this one is a little bit. Yeah. Okay.
I don't want to answer all the questions, but
please.
So I mean, I'm a little bit skeptical about hedge funds. I mean, they only report whenever they want to, so they probably will only report when the numbers are good. So, or the ones that only report are the ones that are good numbers, the poor ones don't. So that's kind of neither here nor there. But the idea being is that you will find an outperformance of the Sharia funds in times of turmoil, and because the idea is that going into the 2007, for example, 24% of the S&P 500 was in the financial sector. coming out of the crisis, it had gone down to 15%. If I'm a fund that's not involved in that correction in the financial services, I'm naturally going to outperform. And so it's during these times that for example, we saw a lot of fund flows into our funds during that crisis. Coming out of it, however, we did underperform because the banks began to do well as well. So you are going to see that, and I think there is an opportunity for Islamic funds to be able to promote this idea that, look, we're not exposed to this financial sector, so when that turn of events happens again, you'll be a lot safer, better off being able to do that. For majority of the wealth people that are out there that have money, if you can tell them, look, I'll preserve your wealth, I won't go down as much as the indexes, and if the indexes are going up, I'll keep up. But I'll definitely go down less when the markets go down. I think anybody would take that trade. And then that's what I think what Sharia funds offer.
I would just add that I think the advantage of Sharia compliant companies, of course, is that the financial ratios are much lower. So in the case of a liquidity crisis, a lot of the portfolio companies within the funds are not exposed as much to liquidity issues as compared to the conventional, the funds that are non-Sharia compliant. Having said that, as you can see, there's perfect correlation. But these companies that have better financial ratios or have better financial ratios would be the first companies to actually pick up on the rise. So I suppose as a selling point of Sharia funds, you do find that anomaly compared to conventional funds.
Actually,
sorry. Go ahead. Oh, okay, just a very quick one. It's easier to sell a Sharia fund to, of course, to a Muslim in these kind of conditions. Basically, if you have a big divergence in the returns, as in 2003 to 2008, when we looked at some of the indices, we had the conventional indices outperforming by about 40–50% over that long period of time, versus that of the Sharia funds itself. We can easily explain that by the fact that some of the finance sectors, the gaming sectors, and all these other sectors, so basically that 50% overperformance over that period of time was due to these sectors. So as a Muslim, do you want to actually have that additional 50% from the so-called haram sectors? It's an easy sell from that perspective. It's easy to rationalize it. Okay. For a non-Muslim, I think we have to move away from comparing Sharia funds with non-Sharia funds as an apple-to-apple comparison, because it's not. It's hard for us. When you put it together with a conventional fund and say it's comparable, it's actually not, because the compositions are not comparable. If you do that, then it becomes easier to sell to a non-Muslim, because again, as my panelists have alluded to, this is a segment or an asset class which excludes finance, which excludes ethical, certain non-ethical sectors. Then maybe from that perspective, it becomes an easier sell.
Yeah, we have also done some testing in terms of whether these financial ratios add any value. So we were treating it as a single factor. There was tremendous value coming out of these financial ratios. That's actually, it's an advantage as well. And in terms of safe haven asset class for this, in terms of turmoil, yes, during the financial crisis, yes, even though they are very highly correlated. But if I have to take the example of the tech bubble, I think that would be a classic case where I don't think we would have escaped the market. I think most of the technology companies that were part of the index were not levered at all, or very little leverage technology companies by nature. I think we would have got hurt, but I don't have any data, publicly available data to corroborate that, but I would assume theoretically that would be the case.
Thank you, Ratna. This is very nice historical perspective, because we often look at 2007 crisis, but then we forget 99, 2000 tech bubble burst, which would have affected all Sharia funds, I guess, equally, or if not more so. We have maybe only 2–3 minutes left, and I'm sure there will be some questions from the floor. So if anyone would like to ask a question, I would open the questions for the floor.
Since time is the essence, I will jump in immediately. So therefore, Ellen, I just want to pick your brains. Given the fact that you believe quite strongly that there will be some intervention by the Fed on the interest rates, and those intervention will also impact, number one, the equity markets, global equity markets, starting with the US. And it's at all-time high at 17,000 and even expected to go at 18 for next year. And if you believe the correction is going to happen, because the Fed rates are going to happen, it will also affect the US, and in terms of the entire liquidity management in the US. So how do you see all of this ironing out? I mean, the Fed will have to make a call that will stabilize whatever is the situation they have in the US, expect a correction in the equity markets, expect a spike in the bond market, and with a volatile with the volatile oil market where the prices are right now, that's going to impact as well. And all of that put together sounds like another bubble that's going to burst globally. Whether they are prepared to do it, and as you alluded to the point, in Europe it's at 0 interest rates, and some of them have moved to that at this point of time. So the impact of that also to the Eurozone. So I can't get it, and I just want to just pick your brains and maybe touch a bit more on that.
Thank you, Arif. I don't necessarily see what you see, but looking up from New Zealand, our perspective is always a little bit different from the other end of the world, especially of the United States. I'm certainly not afraid or concerned or even taken to a deep depression by the fact that the Feds will sometime next year up interest rates. And I see nothing in our outlook why this is going to precipitate some sort of crash. In fact, historically, and I think Monum has probably found the same thing, that when Fed fund interest rates rise off a very low base, we actually see a correlation with equities rising at the same time. So historically, there is something in our favor. But let us look at why I don't believe this will precipitate a crash. Firstly, my topic yesterday was on disclosure and transparency. And since Ben Bernanke's 2 terms at the Federal Reserve and now Janet Yellen, they have ushered in an era of far greater transparency. People who've been watching it, some of them have been confounded, some a bit confused. I've not. I've always watched them very closely, and I take seriously what they say. And we've been able to see the dynamic inside the Feds. And the first and most significant thing that Janet Yellen did was to reverse the first and most significant thing that Ben Bernanke did. He set a limit of 6.2% on unemployment. Within a very short time, Janet Yellen discarded that and said, we will not be mechanical, we will not be driven by a specific target, and we are going to be data dependent, which is the right thing. I don't think the Feds know precisely when they are going to up interest rates next year, because the data as it is coming out is not all that clear. One thing I am absolutely confident about, and I do happen to believe the Feds in this instance, they are not going to up interest rates until they believe the US economy is either recovering or going ahead with sufficient momentum to stand on its own 2 feet. And that is a statement of confidence in the American economy. 16.1 trillion growing at round about 3.8% is an endorsement. Will this precipitate some sort of crash in equities? Certainly, when an announcement comes, you will get a short-term knee-jerk reaction. That I'm certain of. But by and large, most of it, I believe, is already priced in. I look at the 10-year Treasury note, I see what the yields are looking like, I see the curve. Most of what is going to happen next year is already priced in. So, no, I do not believe that there's an area of huge concern. In terms of how it might impact global markets, there will be a number of individual emerging market countries, maybe South America, that could be affected by higher interest rates and higher borrowing costs from the States. And this could affect their currencies and this could affect their economies. But as far as the US economy and its certainly position as the largest economy in the world today, no, I do not see areas of great concern when interest rates rise.
Just very quickly, I think the problem will actually not be when interest rates rise, but the problem will be when they start siphoning out the liquidity from the system. Because basically that liquidity today sits somewhere. Today we have maximum liquidity vis-a-vis during the crisis. You say everybody's the Fed hasn't withdrawn any liquidity. BOJ is pumping in liquidity. ECB, China's all pumping in liquidity. That liquidity sits somewhere in the world today in a particular asset. Past few years, it's been in fixed income, it's gone into property, it's gone into here and there, equities a little bit. One fine day, when they start to withdraw the liquidity, some of these asset prices have to adjust to that withdrawal of liquidity. I think that's the problem. It's not so much of the rates going higher and stuff, it's when they start to withdraw, the adjustment has to come somewhere. I think that's where the crash will probably participate and stuff.
Thank you very much. I think we have time for one more question from the floor, if there is one. Okay, maybe I may ask the question if in that case. Just quickly, because we only have a couple of minutes left, is if rates do indeed go up, and how should Sharia funds respond to it? Portfolio managers, investors, how should they react?
Do absolutely nothing. That's really, I mean, if you think about it, you have to take this from a long-term perspective. If you're a trader in the market, you're going to be buying, selling every day. You might have an opportunity, as my fellow panelists said, to be able to make a short-term, some money. However, because we don't know we can't short anything, then we can't make any money on there anyway. We can just hold cash and then maybe come back in. But the problem with holding cash is you never know exactly when to come back in. So you're probably going to miss out on any kind of uprise that's going to happen. So the best thing to do is hold on to what you have. Probably nothing's going to happen. The world's going to go on, and eventually the markets will come back, and you'll be fine. The one thing that I wanted to add on to that, which is regarding this interest rate, is look, you can take this to the bank. The market only reacts to uncertainty. Okay? Everybody, it's already priced in. The Fed's going to do it. All of the panelists agree that the Fed's going to raise interest rates next year. Guess what? The market knows that too. They're not smarter than anybody else that's up here. So they already know that. And so the market's not going to correct when the Fed begins to raise interest rates. What happened last year in May when Bernanke announced that he was going to cut QE was nobody knew what was going to happen. Everybody's like, oh my God, I don't know what to do. Markets corrected because there was uncertainty. Now we have a path to what happens when the Fed begins to cut off the QE. Last year and this year we have it proven because the QE3 was cut off. So we have that certainty going into the market. The market is certain of that's going to happen, so they're not going to be worried. It's the uncertainty that's going to cause the correction, not the fact that the Fed's going to raise the rates.
I think from a portfolio manager's point of view, be it from a pension fund, it's about asset allocation, right? During the global financial crisis, everyone went into cash, right? But as you know, for pension funds, you're not going to meet your payout rate if you are just going to invest in bonds, right? So as a matter of fact, you have no choice. You have to go into equities. It's about asset allocation. So allocation to equities will always remain. The question is, what is the percentage, right? So I think as far as portfolio managers from the sovereign funds and the pension funds, you have a certain amount to go into asset allocation. If you look at the Yale model, a lot of the allocation went into private equity. Of course, where private equity is concerned, this was not really impacted by the global financial crisis because you couldn't mark to market, right? So, but again, I think the Yale Foundation endowment has actually declared that they're reducing their private equity and hedge funds allocation. So, if you ask me from my perspective, the allocation is going to be there, right? It's just that how much of it is going to Sharia compliant and how much of it is going to non-Sharia. And I would just end with one point that even Muslim organizations do not invest 100% in Sharia products, right? So everybody goes for the yield and the return. That is a fact of life.
If I just, on my side, equities I can sleep soundly at night. I'm pretty okay with the equity side. On the fixed income side or sukuk side, the only problem I have is that I don't have a lot of choices. I would love to have a short duration sukuk fund. I would love to have a absolute return sukuk fund in order to be a bit more defensive. But what I end up with is a 5-year duration sukuk fund. But what to do? That's what I have at this particular point.
Well, thank you very much. Some people here in organizing committee are getting really nervous because we are already 10 minutes over the time, so we're going to have to conclude this lively discussion. Thank you very much, and see you again.